I'm glad you're with me on Money Talks. My name is Mike Campbell. Are you seeing what's going on with your cost of living? I mean, have you looked at what interest rates are doing? More to the point, what the forecasts are 4, 5, even 6 rate increases this year. Maybe you got questions about your mortgage. Well, I've got Kyle Green from the Green Mortgage team joining me to answer them. And speaking of real estate, Ozzie's going to get us an update on that new proposed tax on your home, as well as the implications of the historic lack of listings on the market. And I'm going to give you one of my money back guarantees now. I'm talking about the interview I'm going to do with Lance Roberts. I mean, there's tons to talk about, of course, starting with the incredible pressure being put on central banks to raise rates to fight inflation. I'm going to talk about the political situation in the States that's providing the catalyst for that. But that's not all. I mean, we've got the Federal Reserve, we've got the Bank of Canada all weighing in on this. What is the perception? How high rates are going to go? Plus, I got Michael Levy, Victor Dare is going to be with us, along with a shocking stat about COVID and a goofy that features what may be the low point in the vaccination wars. Plus, I've got great advice from one of Canada's top economists that can juice your investment in my quote of the week. But first, more than ever, we have politicians, bureaucrats thinking they can manage the economy. I mean, I know that's not new. Seems like every election, the media asks who best can manage the economy. But it seems now more than ever, with a dramatic increase in government intervention, amid promises of reinventing capitalism, reimagining the economy. I mean, it's the foundation of Build Back Better and the Great Reset. But it should come with a warning. I mean, come on, it's been tried. And whether we're looking at the former Soviet Union or Venezuela today, the results are frightening. As Margaret Thatcher stated, no theory of government was ever given a fairer test or a more prolonged experiment in a democratic country than democratic socialism received in Britain. Yet it was a miserable failure in every respect. This week, the Economist magazine, which, come on, never been accused of being right-wing or anti-government, it issued a warning, in quotes, "This bossy business interventionism is well-intentioned, but ultimately it's a mistake. It adheres hope for prosperity, fairness, security, but they're more likely to end up with inefficiency, vested interests, and insularity." But I have more straightforward tests. Come on, let's look at two of the arguably the most important financial variables that impact your life directly. I'll start with a question. Can you name me a single politician, central banker, or bureaucrat who forecasts the inflation rate? Well, of course not, because they've been dead wrong. They said inflation would be short-lived and hit nothing like 7% in the States and 5% plus in Canada, by the way, because they measure it differently. And anyone who's filled up their car or bought meat or other groceries knows those numbers are way too low. But my point is that none of the people who pushed to manage the economy saw this coming. Well, more than that, they were dead wrong. Okay, what about the other big story? The rising energy prices. Once again, hey, search all the media. You won't find a single politician, bureaucrat, central banker who saw the huge increase in prices. Not even close as the energy shortages grip Europe. Certainly the central bankers in China didn't anticipate the energy shortages. I mean, look at coal prices up 400%. They didn't in the UK or Europe, didn't anticipate what the finance minister in France is calling an energy emergency. They didn't have an inkling about the impact of both monetary policy, that means interest rates and money creation, with fiscal policy, I mean government spending, on the price of goods and services. They showed no sign of understanding the impact of COVID lockdowns on the supply chain. Of course, we don't choose our political leaders for their sophistication in economics or finance, but that does come with a cost when they push policies without understanding the implications or the consequences. And when they don't, guess who pays? We do. Look at the record energy prices in Europe, totally predictable, as countries discourage fossil fuel development, decommission nuclear power, invested in renewable energy without backup power when the wind didn't blow or the sun didn't shine. Come on, you don't need an engineering degree or a finance degree to figure out what happens when demand outstrips supply. And we're not even close to the end of that story. Demand is going to continue to grow as emerging markets develop, while at the same time, investment in fossil fuels is declining. And renewable energy, well, it's years away being able to power the grid. Presto, higher prices. Hey, just one example, by the way, worldwide demand for natural gas this year forecast by the Independent Commodity Intelligence Services to grow 5.5%. while supply only expected to go up 1.7%. Hey, which means upward pressure on prices, maybe even shortages in some countries. And I'm not talking, just be clear, I'm not talking about political ideology or debating policy. I'm talking about predictable consequences of policy choice. As famed economist John Kenneth Galbraith observed, there are those who don't know, and there are those who don't know they don't know. Increasingly, I think we're governed by the latter, and we're starting to pay the price financially. Fiscal policy, along with supply chain shortages caused by the pandemic lockdown, in conjunction with easy money, set the foundation for inflation. And now it's increasingly recognized that contrary to what the government and central banks told us, it's not short-lived, not transitory, much higher than they thought, which forces the central banks to make a choice between supporting the economy with low borrowing rates or reining inflation in by raising those rates. We're going to talk a lot more about that in today's show, but I don't want you to miss my point. These are the people who think they can manage the economy. Well, if you care about your standard of living, that should send a shiver up your spine. Stay with us as I say, we got a great show planned for you. I'm glad you're here on the Money Talks podcast. I mean, there's so much going on right now. I mean, we're talking inflation, we're talking interest rates, we're talking the market reaction. I mean, this may be a pivotal time, and I want to get the opinion of Lance Roberts. He's Chief Investment Officer of RIA Advisors. Lance, as always, I so much appreciate you finding time, and it is a busy time. I mean, it's not like we're saying there's nothing to talk about when you get your inflation number at 7%, when you get people, I'm trying to think who it was it Ray Dalio who said we could get 7 rate increases this year, and they're going to start tomorrow morning at 3 a.m., whatever it is. So, I mean, there really is a lot. And the market, of course, has to react to that stuff, including the U.S. dollar. So let's start with that whole, the context of which you're looking at the markets right now.
Well, I think it's really twofold. One is, and I think this is the most critical thing is let's set aside for a moment what we're talking about in terms of monetary policy and the Fed and all this, because yes, that's all kind of front and center stuff. But there's a bigger driver behind all of this. It's not just the Fed hiking rates. It's not just the Fed tapering their balance sheet. Don't get me wrong. That is very important. But this is also the problem of a lot of the mainstream media. If you take a look at, for instance, Jamie Dimon just talking about the economy this morning. It's like the economy is very strong. Our earnings are going to be great this year, and we expect this economic growth to continue. And the Fed's going to have to hike rates 6 times this year because the economy is so strong. We all seem to have forgotten that the economic recovery that we've had over the last couple of years was a function of an artificial shutdown in the economy. It wasn't a naturally occurring recession. We shut down activity. That created supply disruptions, but then you fueled the problem of the supply disruptions by giving individuals $1,400 checks, $900 checks, $1,400 checks, $5 trillion of liquidity in total you gave to households. They went out and bought stuff, or at least tried to buy stuff in an economy where there was a supply disruption going on because of the shutdown. So now you've got this artificially induced inflationary pressure in the economy, and we're treating it as if this is regular organic economic recovery post-recession, and it's anything but that. And so my bigger concern is twofold really going into this year. Is the first thing is that all that liquidity that went into the system is now coming out of the system. In fact, the majority of that excess liquidity will be gone this year. Of course, no more. Right now, Biden has been unable to pass his Build Back Better plan. There's no more stimulus in the system. Child tax credits just expired on December the 15th. So that's now leaving the system as well. And now the Fed's going to talk about reducing their balance sheet and hiking interest rates. And let's not forget that this entire economy is driven by debt. So higher interest rates curtail spending, curtails production in the economy. And, this is all going to lead to slower economic growth. And yes, we're going to get a reduction in inflation, but you're also going to get much lower economic growth because of lack of liquidity.
Well, a couple of things there. And one I'm so happy you're bringing up because I sort of smile. And it's the same situation in Canada where the deficit grew $500 billion, and they're sort of trying to bail out the lockdown kind of economy that we created. And I'm going, and you get the numbers, and I sort of go, well, what would you expect? I can throw a hell of a party for that kind of money too. And I love the point you're making. So now we've got to look what happens, because that obviously that level of stimulus isn't going to be there anymore. Right. The expenditures, they can't get that latest Build Back Better bill passed so far, and it's going to be reduced from what all the talk is. So again, you've just set us up beautifully for that big debate. I've got Victor coming on later. I'll talk to him about it too, but I'm not sure how high they could let interest rates go anyways, because we're so awash in debt, right. So there's implications. It's just not, I guess I'm saying it's not a straightforward environment. Well, I'm not sure if the Fed has any easy choice here.
No, and I think this is the really big, the big crisis coming up, I guess, is if you want to call it a crisis or a potential policy mistake here, is that the Fed's really in a tight box. And here's the Fed's choices. I've got 7% inflation, and this is caused by this artificial induction of all this liquidity and a simultaneous shutdown of the economy. So I've got this inflation. The Fed is hoping, and they've got fingers crossed, that inflationary number is going to come down this year as supply chains come back online. Their problem is that they've now committed themselves to aggressively hiking interest rates this year and tapering their balance sheet. And at the same time, they've got to somehow manage this kind of fiscal stability of the financial markets, because if the markets start to decline by 15 or 20% this year because they're hiking rates aggressively, that's going to destroy consumer confidence. That's going to slow the economy towards a recession. Now the Fed's got to make a choice. Well, do I abandon my inflation target to bail out the stock market, which is primarily the top 10% of income earners, talk about wealth inequality in the U.S., or do I continue to ignore the top 10% of income earners and try to focus on inflation, which is destroying the bottom 80% of households? It's going to be, and this is the real challenge. We've got midterm elections coming up. The Democrats are in a very, very bad position right now going into the midterm elections because inflation's at 7%, because they've been unable to pass Build Back Better, because they haven't been able to do a lot of things, because of the vaccines, the viruses, the lockdowns in the economy. All this is really weighed against them. And now you're going to either have a stock market crash or continued inflation. They're not set up well going into the midterms. So it's going to really kind of be all hands on deck. And I suspect a lot of pressure on the Fed to try to focus somehow on threading that needle between supporting the financial markets and somehow hoping inflation comes down.
Let me digress just for a second. I won't stay on this for long, but I just want your take. In the stock market, one of the lessons I learned is I could know all this stuff about the stock market, but the real key became, what is the market focusing on? Not that, it's the old thing when I go, oh, no, they should be worried about what's going on in the Ukraine, or they should be worried about, no. And I learned that lesson the hard way. I better figure out what the market, not what I think, but what the market's thinking or what the consensus. So let me and I promise I'm not detouring for long. What do you think those top issues are for the American public? And I know it's sort of a guess, but is inflation sort of number one, and inflation really translating to, I don't want to go to the grocery store and pay more. I don't want to go to the gas pump and pay more. I don't want to look at my heating bill and pay more. That kind of issue. Is it that southern border which is a huge problem, especially, you'd be more sensitive to where you are, but the southern border, because it's unvaccinated people coming in and we've got vax mandates here. Do you have a sense of what one or two things that are the focus right now politically?
Well, I think if you just kind of focus on Google search trends right now, that tells you everything you need to know. And if you had to rank them in order, the southern border crisis, which is, the immigration problem is an immigration problem. And, that's gotten steadily worse. And again, living in Texas, something that's near and dear to my heart, but that's way on the bottom of the list. Somewhere probably in the middle of the list is the political division between vaccine mandates and unvaccinated, and whether or not you're trying to force people to get vaccinated or not. That's probably somewhere in the middle of the list, just because, particularly in Texas, because we're very independent people, but that's probably the middle list, and right there at the top, and probably the one big concern is inflation. And the reason is because if you take a look at, and we mentioned this segment when we talk about wealth inequality, the bottom 39% of Americans can't come up with $1,000 for an emergency. And yes, we have all this stock market wealth, but it's owned by the top 10% of income earners. So that bottom 90%, they don't have savings. We look at these charts that show all this, there's $2 trillion worth of savings sitting out there just waiting to get used. That all belongs to the top 10% of income earners. They couldn't travel. They couldn't go get on their yachts. They couldn't do anything. So all that cash is just stored up there, but it doesn't belong to the bottom 80% of income earners. They're living paycheck to paycheck for the most part. And so when you have inflation at 7%, that is a tax on those people at the bottom of the ladder. And when you start talking about those in the bottom 50% of income earners, much less those in the bottom 20% of income earners, 80% of their income goes to food, apparel, gas, the daily living things. And, this is one of the things we talk about a lot in on our website at realinvestmentadvice.com, a lot in our newsletters, is that for most people, now I'm not saying for everybody, but for most people, your monthly mortgage payment is fixed, right? Your mortgage payment doesn't fluctuate every month because of inflation. Your healthcare payments, generally you're probably on some kind of, corporate healthcare benefit, or you've got some government plan in place. And so your monthly healthcare premium isn't fluctuating up and down. So healthcare and housing, that makes up a very big chunk of the inflation calculation. But those are fixed for most people. We're not dealing with that every month. But what changes every month? Energy, apparel, utilities, gasoline, those change a lot. So if we add those in and we strip out healthcare and housing, inflation is 11% right now for the average American. And that's what they deal with on a daily basis. That's going to the store. That's filling up my gas tank in my car. And this is an important thing about inflation, by the way. When you take a look at retail sales numbers, as an example, retail sales are calculated in dollars. In other words, we spent $1 million on retail sales. It doesn't tell you the volume that you bought of it. If it used to cost me $30 to fill up my gas tank, I'm buying the same amount of gas at $50. It's just costing me more for the same amount of stuff. And generally, we don't buy more stuff at the grocery store. We buy the same amount of groceries every week. It's just costing us more, or we're getting less because of shrinkflation. So these are the things that you've really got to extract out of this economic data to really understand the pressure that the average American is under and why inflation is really that key component of their big political concern. And when they go to the voting polls, people vote with their pocketbook. They don't vote on policy. Most people have no idea what policy is coming out of government. They just know that they can't make ends meet, and damn it, they want to change.
And that's exactly my perception. I mean, we look at energy price, the big jump here. Can you imagine being a European, for gosh sakes, on that score? But you look at energy prices. Food is a big one, too. I mean, one of our themes on Money Talks for 2 years has been look for rising food prices. And when I look at the petroleum increase, we talk about this a lot on this show, then you look at the fertilizer increase because the natural gas prices skyrocketing. That means, some farmers won't be taking that. I'm thinking especially in the emerging markets, the crop yields go down, prices go. I mean, this whole mess to get the energy policy so wrong. As Europe is giving us a vivid example. I don't have to sit there anymore, Lance, and go, hey, you just wait. You're making a mistake here. I don't have to do that. I just look at Asia. I just look at Europe, and I look at still some of the pricing that we're getting in North America. It's not as dramatic. It's funny. I'm saying that when you look at natural gas prices up 10%, and I'm saying it's not as dramatic, but that's the environment. And I think your point is just so well taken when you say, look at the percentage of people. Inflation always kills lower income families, always kills them. And when you're talking about the percentages, you're talking about who can't get $1,000 together. And it's not different in Canada. We get numbers like 53% of Canadians don't have $200 left at the end of the month, and we're going to eat that up. So it's fascinating. But that brings me right back then. It would seem that there'd be real pressure on the Federal Reserve to do whatever they can to help rein in inflation.
Right. But the problem with that is there's an economic consequence to that. And also too, let's really step back for a second. I think I think there's just the ultimate hubris of the Fed to honestly believe that they actually can affect inflation or economic growth, et cetera, with monetary policy. I mean, we've seen for the last decade and almost 2 decades now, the Fed's been much more active in trying to manipulate monetary policy to create economic growth, and they still get 2% economic growth. They've had no inflation for the last 20 years. Inflation's been running below their target of 2%. And now, because you have this artificial influence of a shutdown in the economy and $5 trillion in liquidity, now you have obviously inflation because of the supply demand imbalance. They're going, oh, we need to raise interest rates now so we can fix inflation because that's our target. Well, your policies don't affect any of that. What it does affect is create wealth inequality. We've seen you do a very good job of that. But the hubris of the Fed to think they can actually bring inflation down to 2% and then stop it at 2% is just mind-boggling as to just, what their policies are, what they're saying.
And as I said in my editorial, you wouldn't have heard it in the editorial, it's not like they sat there a year ago when inflation was 1.25 or something, in December and said, you know what, I think it's getting to 7%. No, they've been completely blindsided by this. It's not transitory, by their own talk. Yeah. But let's talk about and bring it quickly because I don't want to run out of time. Bring it to investors.
Yeah.
And what are you telling investors to do in this kind of an environment?
Well, this is where you're going to have to start really rethinking kind of a lot of your strategy. One thing we've been talking about really since December, when they started getting a lot more aggressive about hiking rates. Now, mind you, they haven't actually tapered anything yet. I just ran an analysis on their balance sheet, and they're still buying bonds like crazy. So they're doing a lot of talk right now to try to talk down the market and potentially talk down inflation. We'll see if that works. But, this is where you have to really start rethinking where you're putting capital. So, a lot of these high beta growth names that we saw really outperforming since the March 2020 shutdown, the Snowflakes, the Asanas, the Etsy's, the Shopify's, all these type of disruptor technologies, these companies that have massive valuations trading at 30 times price to sales. These are great companies. I'm not bashing the companies. It's just their valuations are so elevated and we're so dependent on this massive amount of liquidity that we're given to retail traders. That's now liquidity that is now coming out of the markets. And now you're starting to raise interest rates. Now, let's step back 1 second and I'll answer the question more precisely. Why do we raise interest rates? We raise interest rates to slow down consumption, right? We want things to cost more for people. So if I go to buy a car, the loan costs me more. I can't afford to buy as much of a car because the interest rate is up. I can't buy as much of a house because interest rates are up. I can't borrow money at a low rate. So that slows economic growth. When I slow economic growth, I slow inflation because I'm slowing demand in the economy. That's how I bring inflation down. It's not, and this is one of the ideas of the Fed is that you can affect inflation, but nothing else. And that just doesn't work that way. And so you need to really think from an investor who can withstand an economic environment where it's going to be slower economic environment, lower inflation coming down. That means price declines, deflationary pressures within profit margins. Where can I invest? And that's going to be more on the value side of the ledger. Look for companies that they're the old boring companies that are trading at a discounted PE right now that have strong cash flows that pay out dividends on a regular basis. And you've got to be careful. Coca-Cola is a good example, is not a value stock. It's been run up well beyond what its value is over the last few years. Disney is not a value stock anymore. It's been run well ahead of what its ability to grow revenues are. So you're going to be much more selective about where you find value in the market. And, this is one of the interesting things is that we're all talking about how we need to move towards, electric vehicles and green energy. And we need to abandon those dirty old oil companies. But unfortunately, that's where a lot of revenue and a lot of value is right now. So from an investor standpoint, you've got to separate out your philosophy and your policy from making money. And those are not mutually exclusive always.
And let me come just quickly, throw a couple more at you very fast here.
Sure.
What about gold? What about gold?
Gold's been an interesting thing. Gold is a function of real yield. So that's inflation adjusted yields. So I take my 10-year treasury rate, I subtract out inflation, and that's my real yield. Gold responds historically very well to inflation, to real yields. That correlation has not worked a whole lot this year. Gold remains very suppressed. And there's been a change in gold over the last couple of, now this is my opinion only, and I'm sure I'll get a lot of argument on this. But I've been following gold for 30, 40 years. So it's just a difference. There are periods in history where gold performs very well with inflation. There are periods in history where it hasn't. This is one of those periods where gold has become more of a fear trade than an inflation trade. And what I mean by that is that it hasn't responded well to inflation, but it does respond much better when there's fear in the market. So when the markets start to decline, money rotates into risk off trades from risk on, and risk off trades have been gold and 10-year treasuries. And so, all these people saying, oh, the bond bull market's over, get out of bonds, only be in equities. Mike, as you know, I've been a bond bull for, 15 years now. And every time we get rates run up, I start buying bonds. We've been buying bonds for the last couple of months here because rates are pushing back up here. And when the Fed is hiking rates and reducing liquidity, yields fall. And so I'm trying to get ahead of that curve.
It's absolutely fascinating. And the great news for people is that they can get more from Lance, and it's absolutely free. And there's a lot of ways you can do it, but easy to remember is realinvestmentadvice.com, realinvestmentadvice.com, or RIAadvisory.com. And right there, they've got the newsletter. You can see it right there. You can just click on the blog or click on the newsletter and get Lance's most recent thoughts. He does it. I mean, he's working his tail off, actually. So I'm glad he had time for us. But, and you can find his latest thoughts when we get a change or he sees something coming. You can just click on that. So that's one way to keep it in touch, but also keep in touch with us on Money Talks because we've got to get you back again real soon, Lance. That was great stuff.
Anytime.
There's just so much happening as you're hearing here. Lance was great, but I want to remind you that we have the Outlook conference coming up, and our goal is to protect you. And I'm just love to hear Lance is bullish on oil. What do you think we've been? But also on other commodities. But what do you should stay away from? All of that stuff we're going to handle with the likes of Greg Weldon, Martin Armstrong, Mark Leibovitz going to talk cryptos this year. So a lot of there. So again, I'll just tell you to go to mikesmoneytalks.ca. Don't hesitate here. Just click on the events button. And go, of course, from the events button, you can see right there, Outlook Conference 2022. Stay with us. So I still got a Goofy Award. I still got Victor Dare. There's a lot. And we still got a shocking stat. All of that coming your way. You'll love the shocking stat. Time now for the quote of the week. And this is a great quote. Whether your goal is to improve your investment track record or you simply want a deeper understanding of today's issues. And it comes from David Rosenberg, one of Canada's best-known economists. And he offers this advice, which will, by the way, no doubt be immediately rejected by maybe some politicos, activists, some of which occupy academia and the media, who have ushered in the modern era of anti-intellectualism with their no questions allowed dogma, which is contrary to the approach recommended by Mr. Rosenberg, who says in quotes, always focus on your blind spots. I say that over and over, and that's why I spend all my time reading people who disagree with me so I can continuously have my thesis tested. We're all going to make mistakes, but we should do all we can to minimize them and certainly avoid big, costly ones. End of quote. Well, as I say, absolutely the opposite of what's tragically become the norm in so many areas of society. There's a narrative and don't question it. But it is interesting also, a big difference between investing and just sort of say public dialogue. And the reason is straightforward. When you're wrong in investing, you pay a direct price. You lose money. That is a huge motivator to trying to reduce your risk, to find techniques that help reduce your risk. And as I say, Mr. Rosenberg echoes what so many others in this field say, and that is always focus on your blind spots. Spend your time examining what people who disagree with you think. Then you can test your thesis. That's going to help a great deal. I wish we'd apply that to other areas of society. Well, Canadians continue to tell us that, hey, their cost of living is their biggest concern. And no wonder when you look at what the inflation numbers were. I just alluded to them earlier. But yeah, it's a big deal. When you get the U.S. coming in at 7%, we'll get our Canadian numbers this coming Wednesday. And it's certainly going to be in the 5% range. I'm going to bring Michael Levy in to talk about this because, Mike, it's got a couple of big aspects to it. One is, of course, I'm paying more for stuff. The other, though, is it has a huge impact on the bond market and interest rates. Why? Because why would I take, say, 2% in a 10-year bond when inflation's running so much higher, guaranteeing a loss? So I want to just delve into this a little bit more. I mean, it's not like this is the first time, but it's been a long time since we've seen numbers like this.
Mike, since 1982, when inflation hit 7% in December of that year, And just a little context to it. The last time consumer prices, I say, clocked in was June 1982, but the circumstances were different.
Yeah, I mean, what were we? We're coming down, I think, at that point, right? As opposed to, in this case, we're going up.
Isn't that something? Because when you try and wrap your head around that, inflation was at that level in 1982, and then you said coming down. Well, in fact, they were 14.8% in 1980, and listen to this, rates reached 19% in 1981, and that's when a really deep recession hit.
Let me come back to something here. Like, as I say, the Canadian numbers come out this week, this coming week, but we don't measure everything the same. So ours may come in at 5.5, theirs at 7, that kind of thing. But they're including some things in their numbers that we don't in ours, even though it is more expensive in Canada. I mean, we are paying more for some of these things.
We were just talking about that this morning, and it's just beyond me why Canada can't count used car sales in our numbers that the U.S. counts it. I mean, they've got to be cars that have been registered and everything. So, in fact, you're right. And used car and truck prices in December soared 37.3% from a year earlier. Listen to that. 37.3% higher from a year earlier. Living room, kitchen, and dining room furniture jumped by 17.3%. And Mike, you've been pinpointing how food inflation is just hitting everybody, no matter where you go, not only inflation, but shortages. And those shortages cause even more inflation. But we aren't comparing apples and apples, you'll excuse the pun, with U.S. and Canada. So if Canada comes in at 5% and the U.S. is at 7%, you can be rest assured Canada, if we counted everything like used cars, we would be the same or even higher.
Yeah, I'm just thinking to myself, if I had just not bought any stocks or made any investments and just bought used cars a year ago, I'd be better off. 37%, pretty darn good. Yeah, but that's one of the big things. Mike, I want to come to two things here. One is that what's driving it, and the thing that has got a lot of economists worried is the wage pressure, because obviously once wages go up, now that's another cost increase for business.
Well, it is, Mike, and wage inflation is probably one of the most important factors, and we've been talking about this. You have shortage of labor. Unemployment rates are coming down to lows that we saw before we had the hit of the virus back to 2016, I believe, 2017, when employment rates were down around 3.7 or 3.8%. Well, that's where unemployment is going now, and it's the same in Canada as in the U.S.
And again, with the wage inflation, we'll get passed on. But the other driver here, or at least I want to know, or the other concern, as I said up front, was I'm worried about interest rates and where they're going. And I mean, we're starting to see, even if we went back a month, maybe we were pricing in 2-3 interest rate increases, but now we see a lot of financial institutions and analysts saying there's going to be more than that coming. We had the Royal Bank, for example, join us, 3 other major banks saying the Bank of Canada has got to take immediate and rapid action with multiple rate increases.
And one of the things we're starting to hear now, and I mean just starting to hear it, is the Bank of Canada when they announce later on this month, on January 26th, when they have the meeting, we may see Canada's first interest rate hike in January, not waiting until April. And Silvana Domino, she's an economist with JP Morgan Chase. She is now looking for up to, and listen to this, 5 interest rate hikes in Canada this year. That's not to say it's going to happen, but that is where the numbers are leading her, and a minimum of 3 in the United States. But Mike, even if we saw 5 of them, we're still not going to see interest rates coming out of the Bank of Canada at any more than 2 or 2.5%. It's not like they had back in 1980.
Well, one for everybody to keep an eye on at that stage, and we'll do exactly that. Mike, thanks for taking the time.
Thanks, Mike.
Well, if you're dealing with finance, of course, you're talking about interest rates, talking about inflation, as we've done today. But I want to get practical right now. A lot of questions about people who are in the mortgage market already, who want to know what to do. So I asked Kyle Green, president of the Green Mortgage Team, to come on with me and chat about this stuff. Kyle, let's start with what's the environment right now? I mean, we've been watching and chronicling the move in the bond market, for example, and that 5-year Canada rate does impact 5-year rates. What have rates been doing?
Yeah, we saw major increases last year, actually. Bond yields had a huge run up. I think the biggest run up we've seen since 2009 in the bond market last year. There's two major increases in movements. We saw early in the year, early in the spring, a number of movements up, and then another large movement up later in the year around October, November. So we've seen two major big pushes up. One interesting part is that when Omicron came out, we actually saw bond yields drop in about 0.4% from peak to trough late November until late December. We've actually seen the rates completely rebound and make up for all of that drop just in the last couple of weeks in early January. So we're starting to see now that banks didn't want to drop their fixed rate mortgages, even though bond rates were dropping during Christmas holidays. I don't think any bank wanted to step forward and say, hey, we'd like to be busier during the Christmas holidays. So we didn't see much movement there. But now I'm just starting to see movement. I literally saw an email about 15 minutes ago. It looks like TD might be moving up as of Monday. Scotia has already moved up. I think that the big banks are moving up just a little bit, about 0.1%, but they're starting to move up.
Well, again, the big key here, and it's something I should reiterate, and I don't often enough, it's all about perceptions, the actual move in the market. And then it becomes what the bond market's reaction to is what's going to happen. Like, okay, we've got this. Oh my goodness, we might get that. But it just explains to people why when we look at housing here in Money Talks, we also look at the 5-year bond market, for example, all the bond market, of course, for a couple of reasons. Well, let me just step back. You deal with so many people, your team does. And of course you do too personally, but what kind of questions has this begged as we've come out of the Christmas season? We're now, full swing into the new year. What are you hearing?
I mean, a really common question is, Kyle, should I lock in my variable rate into a fixed rate? That's a really common one that comes up. Another common question that comes up, and we get this probably daily as well, is, Kyle, my renewal's coming up in summer of this year or in fall of this year. What should I do? Should I break my mortgage and redo it early? Should I wait and then wait until the renewal comes up? And so those are questions that come up. So if the question comes across my desk, should I lock in my mortgage? A lot of the time we're looking at the spread on what you're currently at on a variable, which is probably around 1.5%. If you're locking in your mortgage, you're probably getting into close to 3% to lock in your mortgage right now. And usually the question revolves around, what is the likelihood you might break that mortgage later on? I think over a 5-year period, I think that the variable versus fixed cost will be fairly similar one way or another, unless you break that mortgage early, in which case the penalty cost will be likely 5 to 10 times more expensive to break that 5-year contract than it would if you were in a variable rate, which is just 3 months interest. And then with determining what to do with your renewal coming up, some lenders will do an early renewal for you 6 or even 9 months ahead of time. So make sure you check with your bank, get a quote on that, and figure out what those rates are. And if you want to bounce some ideas off of myself or my team to figure out if those are competitive, then we can help with that. But in general, those early renewals may allow you to jump into a fixed rate early now before they do rise, which I do think will happen this year.
Yeah. And two things you've just immediately said. Know what your mortgage is about. Like, what penalty would you get? Number one, do you have early renewal? And if not, or if so, well, that may answer the question for you. If not, then what would be the penalty? But I mean, I know it's straightforward, but check what the numbers are. And that leads to the question I'm getting, which are also the ones you've just said, especially the early renewal I'm hearing about. But the other I'm getting is, okay, I've got 2 years left in my mortgage, or I got 3 years left in my mortgage, and now I'm worried about what they call blending and extending. Tell me a little bit about that.
Yeah. It's an interesting topic because actually during COVID, this was a very common thing where a lot of lenders were doing this. A few lenders actually stopped doing blend and extends. And the reason for that is there was a weird little loophole where if you blended and extended with some banks, your penalty cost may have shrunk. And so some people blended and extended and then broke their contract immediately after, which reduced their penalty from $25,000 to $5,000. Yeah. So people got pretty smart with it. guess what? The banks are even smarter. And so a lot of them are now not doing blends and extends. So it may be possible, you have to check with your bank, but in essence, a blend and extend means that you go from extending your 2-year contract out to 5 years. And effectively they're just balancing out and weighting the average rate and giving you a new 5-year contract at an average rate of what you have now and what the current rates are.
Are you worried? And I know this is a broad question, and it's hard to get the empirical data for it. So I'm just getting your impression. But are you worried that, one of the things we saw is obviously a lot of people rush into the housing market. We thought on our show, in Money Talks, right from the get-go in March, when the Bank of Canada, March 2020, said, we'll guarantee mortgages, basically. When they came out, I said, well, wait till you see the rush into housing at that point.
Yeah.
Because you're going to get these record lows. And sure enough, the financial institutions lowered their rate at that moment. They had been worried too. They've been worried about what the impact of COVID. Well, that impact was gone when they did that. But, worries about a lot of people got in a little too far over their head, or they were pricing themselves for perfection. Like, as long as housing never goes down, as long as I keep getting a raise, as long as the price goes up. Are you worried about that? Do you think there is overextension in this market? Because you sure heard the government talk about it.
Yeah, the overall amount of debt in Canada has increased significantly, and that's obviously a concern as Bank of Canada needs to consider increasing interest rates. And if you have more debt in the country, then it's going to affect the entire country in a much larger scale. But when I look at an individual level, keep in mind that we have had the stress test, which means that everybody's qualifying at a rate of 5.25%. Even in a 5-year period, I personally don't believe that we're going to hit rates of 5.25%, but yet that's the rate that's being used to calculate and qualify individuals when they get a mortgage today. So everybody has to qualify as if that is their interest rate, which means that it already has been stress tested. I don't see what I saw maybe 5 to 7 years ago, where people aren't running out and writing offers left, right, and center on 10 pre-sale condos. I don't see that speculative purchasing right now that I saw 5 or 10 years ago. I'm a little less concerned about this market than I would have been 5 years ago based on that. And especially with the stress test being a blanketed over every single borrower, they're pricing in that rate increase right now.
Let me just, before I let you go, I want to come to something else, new subject here.
Yeah.
And that is about the talk about raising the down payment someone would have to make on, is it just restricted to investment properties?
Yeah. So there's some talk about that. It's very early stages, but CMHC is involved in the talks and conversations. And so the concern is that they may be increasing the down payment to 25, maybe even 35% down for rental properties. And I think that some stats came out, and I haven't validated this myself, but I read it very quickly, but up to 25% of all purchases last year were for investment purposes, which is absolutely insane. So that's much higher than what we've seen in the past, like 2 to 5 times more than what we typically see in a market. If that is the case, and they do come out with much larger down payments, that has a large negative impact on your return on investment. If you can put 20% down instead of 35 or 40% down, let's say, well, your ROI, your return on investment is nearly double if you can put 20% down instead of 40% down. So it's something to consider. And if they do start to come out with some rule changes, it may be, if you're on the fence and thinking about it, it might be worth jumping in now, as you might not have the opportunity to put just 20% down soon.
Just very quickly, if I get pre-approved for a mortgage, and different financial institutions might give me 30 days, 60 days, 90 days, can they change that, or is it ironclad, if you know what I mean? Like just as you said, you've kind of been thinking about an investment property. Your point is so well taken that the amount that you have to put down has a direct impact on your return on investment, obviously. But so let's say I got a 90-day out there and I had my eye on selecting something. Can they change that because the rules like that change? Or
yeah. So when governments change a rule like this, they will say that you will have to have a live contract by a certain date. So they'll probably come out with it and they'll say, okay, everybody that has a live contract dated on or before this date is grandfathered, as long as they complete by this date. A pre-approval will not do that for you. Pre-approval is just going to hold the interest rate, but it will not hold policy.
Great stuff as always. The Green Mortgage Team. Kyle Green is the head of it, of course. The Green Mortgage Team. Kyle, thank you for taking the time. And you're going to be with us at the World Outlook Conference, which is great. And that's the time to come, and you'll get a chance. Kyle will by then have another, well, maybe the same list, a whole list of questions that he'll make sure he answers in his presentation, the ins and outs, because obviously the most important financial decision for most people is when they buy a house. And so there you go. Kyle, thanks for taking time. Great stuff.
Yep. Thanks a lot, Mike.
Let's go to the shocking stat of the week. And for it, I'm going to go to the director of the U.S. Center for Disease Control. Her name is Dr. Rochelle Walensky, who stated this week that, in quotes, the overwhelming number of COVID deaths, over 75%, occurred in people who had at least 4 comorbidities. The CDC website notes that close to 95% of death certificates listing COVID as the cause also mention other causes along with COVID, and states, for deaths with conditions or causes in addition to COVID-19, on average, there were 4 additional conditions or causes per death. I'll add that as early as February 2020, before any lockdowns, we already knew that the most at-risk group were those over 80 suffering from pre-existing conditions. And then you had obesity was the second most important factor because, again, due to related medical conditions. So over the last 6 months, this is interesting. The risk of a person between the age of 15 and 24 dying from or with COVID is 1/1000th of a percent, 0.001. Since January 2020, the number of children between the age of 0 and 17 who've died from or with COVID represent 8/100ths of a percent. I mean, these numbers are going to shock a lot of people because we've been inundated with stats without any context. I think most notably, and we're starting to hear a lot more about it right now, is that we hear the death toll, but they don't differentiate between those who died from COVID or those who died with COVID, which I think distorted the perception of risk and increased fear, which in turn led to highly questionable policy decisions, motivated, though, by that elevated risk parameter. And it started, by the way, right from the beginning, right at the outset. Both when Canada, UK, other Western governments relied on the Imperial College of London model as the rationale to lock down society, an approach that the World Health Organization, by the way, and respected institutions like Johns Hopkins had rejected just months before the lockdowns were enacted. And there was no empirical data that would propel us to change that policy. It was based, though, on faulty modeling. The Imperial College of London model forecasts that COVID would kill 510,000 in the UK. This is the original, no variations there. 2.2 million in the US, 326,000 in Canada. And again, I remind you, when we're looking at the model's forecast, we should, and we want to compare it to actual numbers, we should only be compare it to people who died because of COVID, which is why the CDC, and this is now, the CDC director now says that the focus should be on people with comorbidities. CDC says they should take steps to protect those at highest risk, including those with chronic health conditions, disabilities, and older adults. And by the way, I think that's exactly what the Great Barrington Petition started to talk about in October 2020. 910,000 experts have now signed it. That's the one, by the way, where right from the get-go, Anthony Fauci and Francis Collins, director of the National Health Institute, tried so hard to discredit and shut down open discussion. Well, now we see the CDC going in that direction. Let's protect people who are the highest risk. Hey, we still got a lot coming up for you today. I mean, including we've got Ozzie Jurek, I've got Victor Adair, I've got a Goofy Award, all of that coming your way. And a reminder, you should join us on Money Talks tweets, and join us on Michael Campbell's Facebook, as well as mikesmoneytalks.ca. You're going to get a lot of stuff there that you never hear in the mainstream media. And the point only being, the more information you have, the better it is. Plus, of course, you can sign up, as I've been saying, for the World Outlook Conference. Just go to the events page. All of that coming your way. Well, we caused quite a stir last week on the show talking about this new proposal for a tax on primary residences. But I want to take it back a little bit, because 2 years ago, I'm going to bring in Ozzie Jurek right now. Ozzie, 2 years ago, we talked about the CMHC providing, I think it was about $250,000 cash for a study that they were accused of, hey, you're looking at taxing the primary residence. And they gave us a big, no, we're not. Well, then we get the same group coming out with a proposal to have new taxes on your primary residence and all real estate, actually, all residential real estate.
Yeah, and it shows clearly we were right 2 years ago. I mean, CMHC was studying that. They also forecast a crash in the housing market of 18%. But the thing is, this new proposal to solve our affordability problems is to increase the tax, just the wealth tax, for homes over $1 million, and it would be 0.2% for homes valued between 1 million and 1.5 million, and 0.5% between 1.5 and 2 million, and then 1% in homes valued over 2 million. So the tax bite would be considerable. I mean, 1% of $1 million is $10,000. If you had that for 10 years, that's $100,000 you now owe to the government. You don't have to pay it until you sell it, or until you die, your estate has to pay it. But think about that. The average home price in Vancouver isn't 1 million. It's 2 million. We're talking the average home price between Mission and Lions Bay. So at 2 million and 1%, now here we have 20,000. So in 10 years, is that 200,000? Now we're talking a substantial tax bite. And then just think about that, Mike. There will be 8 years in a row, let's say, where there's no price increases. I owe the money.
Okay, I want to make sure everybody's got those numbers. So they're talking about homes over $1 million. So $1 million to $1.5 million, 1.5, it's at 0.2%. So that means you're going to pay $2,000 to $3,000. 1.5 million to 2 million at 0.5%. That means you could pay anywhere from $3,000 up to $10,000. And of course, as Ozzie just said, 2 million and up at 1%. Well, that's $20,000. And again, Ozzie, it's not that people necessarily have that level of cash flow lying around. And as you just alluded to, try that over 10 years at $2 million. Let's say you got a $2 million home. Try that over 10 years. That's 200 grand. I mean, this is serious stuff. And I guess that's why we got the reaction last week.
Well, and they say, don't worry about it because you don't have to pay it until you sell the house or until you die. Well, the crazy thing is we don't always have price increases. Well, we may have them for a while longer, but what if we don't? We will have the tax with us. And the other thing is that right now it is 0.2%. It's very easy to make that 0.3%. And 1% goes to 1.5% and so on. It is a tax grab of a major proportion on what is really a holy thing, the tax-free amount of capital gain.
Well, we're going to have to we'll keep an eye on that. But it's, again, I think we come back to governments will be desperate for money. They've got to look somewhere. Well, most people have their wealth, or if you're lucky, it's not the majority, but the majority of your wealth in a primary residence, so that's why I think it's an easy target. We'll obviously do more on it. But I think, as you said many times in the past, Ozzie, it'd be so unpopular politically if people really look and understand it. What we're just pointing out is this is yet another proposal to take taxation out of your home. This is, there's so many other examples they've done over the last couple of years. But I want to come to another subject for a sec here. And that's something that, again, you've been chronicling on ozbuzz.ca. And that is, let's talk about some of the ramifications. I just saw these numbers, from December. The low listings have got to be the thing that jumps out at people.
Yeah, it's mind-boggling. I think when we started last year, I was very surprised to report that we had 150,000 listings nationally, and that was the lowest in 30 years. Well, since then, we have just absolutely collapsed in the number of new listings and active listings. In Toronto, for instance, which remembers a city of 6.5 million people, they only have 3,200 homes for sale. Last year, they had 8,000 for sale. And if you take a look at the same time that sales in Toronto are up 120 to about 121,000, breaking any records in the past, and prices are up to $1.1 million. Well, there's a huge thing. Prices are up, sales are up, and listings are down, and the pressure in Toronto is dramatic.
Well, and again, we've been chronicling this as something I tweeted out this week, is that we've got to remember the backdrop is we're welcoming 1.2 million new people into the country, and there's no national strategy for supply. And you're just elaborating there is look at the problem with the low number of listings. No wonder prices don't fall. I mean, we must be back, Ozzie, to several bids on a single property, because where else are you going to go?
No question, because if you were surprised at Toronto, the Fraser Valley active listings are down 72% over last year at this time. And when you look at the city of Vancouver, while the volume is down, volume of sales, listings are down, and condominium listings are down 51%. And you say, well, how come there are not more listings? Wouldn't owners want to sell? Well, no. Look, an owner in Surrey has sit in his house for the last 2 years and made $350,000 a year doing nothing. And he says, Martha, I don't know where it's going to go, but I'm doing pretty good right here now. And that's the average price. Normally there's all sorts of people that are sitting in a $2 million house and saying, you know what? I paid $1 million for that in 2019. I don't know where to go. But what is happening again is the multiple offers.
And as you say, I mean, it's finally slowly getting acknowledged, or at least out in the public more often, that it's a supply problem. And the number of listings, of course, is part of that issue. And I just don't see where prices can go when you have that low listings. I mean, there's no, it's definitely a seller's market when you're one of the few people selling.
Yeah, no question. But of course, you talked earlier with Michael Levy about rising interest rates, and if we do raise interest rates, it does have an effect. So we are sort of on a razor's edge, and there is some really, we have to really be carefully watching what the future holds in the next couple of months.
All the more reason to go to ozbuzz.ca, ozbuzz.ca. Check out Ozzie keeps track of that market on a daily basis, obviously. I think he does it on an hourly basis most times. But he's got like one of those smart watches that pings every sale. Ozzie, thanks for taking the time and have a great week.
Thanks, Mike. And I would urge all the listeners to sign in today or tomorrow into the ozbuzz.ca, because if you sign in, we get your email and then we send you the next Ozbuzz, which is out Sunday. And all these numbers we just talked about will be given there. I just want to leave them also with this thought, that the factory of the future will have only 2 employees, Mike, a man and a dog. The man will be there to feed the dog, and the dog will be there to keep the man from touching the computer.
Ozzie Jura, go to ozbuzz.ca. Well, you've been hearing about inflation, of course, interest rates, big time topics this week. I want to bring Victor Adair in live from the trading desk. Vic, let's start with the interest rate story. And we're talking about the reality, about the perception, and about the forecasts all around there. And the politics, too, are a big part of this when you look at what's happening in the U.S.
Yeah, I mean, the obvious thing is interest rates have jumped. Yields on the bonds have gone up. The market right now looks to be pricing in at least 4 quarter point increases by the Fed this year. But there's sort of 2 schools of thought. One school of thought is we're at peak hawkishness. The Fed will say more bark than bite, that because there's so much debt in the world, they can't put interest rates up too far. And for sure, if the stock market starts to have a hissy fit, the Fed will back off. Other folks say, oh, no, this is a big deal. You've seen a sea change in the way the Fed operates, that the interest rates are going to go a lot higher than is presently priced in the market in a short term. And one of the political reasons, to go to your thought on that, is Biden right now is like bottom of the barrel in terms of popularity, and the Democrats are looking at losing control of both the House and the Senate in the midterms coming up in November. And if they look around and they say, what's the biggest concern on people's minds that we can maybe do something about? It's inflation. So they may, in a way, instruct, ask, beg, the Fed to kill inflation. And we really don't care if the stock market takes a bit of a dip, because there's a hell of a lot more people voting that are going to like that than people who own shares.
And I say that's how you've described that perfectly, as we were chatting with Lance about that kind of thing too, is that this is the precipice we're on. And we talked with Jim Thorne a week or so ago and saying, well, can the U.S. or anyone else even afford to have significantly higher rates? But the point I want to bring about that, though, Vic, is it's not really the quarter point rise, the next quarter point. It's the perception of where rates are going. That's when the bond market's going to take a bailout. If you obviously to this point, and I know we've had a correction there, but still not that big a correction. So it's not anticipating the sort of follow through that many think it's going to happen. So if, I'm not going to own that 2% 5-year bond or whatever it is, if I really now get convinced that inflation's running 4, 5, and 6% on a more permanent basis. So it's the perception that we're really dealing with here.
Absolutely. I mean, the market is always pricing perception. I mean, we had the perception, say, last fall that inflation was going to, be a huge runaway event. We got the CPI numbers hitting 7% now, but it's like, okay, that's yesterday's news as far as the market is concerned. And, the reality is we're probably going to see those numbers actually decline as the base effects from where we were last year wear off and all of that. I think one of the manifestations of the idea that that we've kind of hit peak hawkishness is that the U.S. dollar has actually weakened here the past 3 weeks or so after trending higher for the latter half of last year. One of the reasons the U.S. dollar was going up against other currencies was the thought that American interest rates were going to be higher and get a lot more higher than other parts of the world. Well, if maybe the interest rates in America aren't going to go a lot higher and maybe the rest of the world to some degree will catch up with American rates, then the market looking ahead is already starting to sell the U.S. dollar and buy the euro in particular, or Canadian or Australian, what have you.
That's such a great example, though, of this tug of war that we're seeing, this teeter-totter of debate going on. But I want to come to something else here. I want to come to the crude oil market. One of my happy thoughts, because, I'm bullish on the price over time. And I'm not talking as a trader. I'm talking over time. 7 years of underinvestment. It's been a major theme on Money Talks. But man, were we rewarded when you look at what's happened since Thanksgiving.
Yeah, I mean, Thanksgiving was, let's see, we're not on radio, so we can use rough language, but anyway, I won't. Thanksgiving was a disaster. I mean, on Thanksgiving Friday, which is normally a sleepy half-assed day, the crude oil just tumbled. Anyway, we got down there. The WTI is now $20 or more than $20 above the lows we made then. We're at about $83 on the front month, so we're close to the $85 highs we had back in October, November. The Canadian dollar, by the way, has kind of tracked, I think, a good part of that rise in WTI. I mean, crude has had this bounce. We don't want to go far down the rabbit hole in terms of supply and demand, but there are these political or geopolitical tensions. Certainly what was happening in Kazakhstan, it kind of makes what's going on or may be developing in the Ukraine that much more important. And I think there is a bid in the crude oil market just on the off chance that some of these geopolitical things get a little hotter. And you definitely don't want to be short if that happens.
I don't want to leave this without coming back. Sorry, I could have done this a little earlier, but coming back to the Royal Bank and the bank stocks. And just to remind people, bank stocks like higher interest rates. Their margins get a little bit better. And we've certainly seen that reflected.
Yeah, I mean, I look at hundreds of charts, and I looked at the chart of the Royal Bank and it just like, wow, look at that. It was $98 a share at the beginning of December. It's 116 today. And honestly, Mike, I don't know if those are U.S. prices or Canadian prices, probably U.S. prices given my quote provider. But yeah, the banks, they particularly love a spread where the difference between short rates and long rates is wide. But this move here just goes to show you, there's some markets are getting hammered, like, for instance, ARC. We've trotted out poor old Kathy Woods there,
yeah.
But she's got a basket there full of what you'd call someday winners, that are not generating any profits now. Her shares are down 50% from where they were a year ago. And so stuff like, crap is getting hit, where something like the Royal Bank is getting bid like crazy.
Yeah. Well, we talked a bit about ARC with Lance earlier, but it's exactly that, because it became such a poster child for that frothy, tech innovative market, tech disruptor market. But yeah, it's had a tremendous decline. But that's back to our theme, Vic, going back quite a while, you've got the NASDAQ so dominated by about 8 stocks that the NASDAQ index can be much closer to its highs. And then you start uncovering and you look a little deeper And, you see half the stocks down about 50% from their highs. It's, I think it's actually 38% are down 50% from their highs. So yeah, it's all of these things you've got to look within the market at.
Yeah, within the market, I mean, the indices are down a couple of percent sort of thing from all-time highs, but some of the internals, I mean, it's all been about rotation within different sectors, and the financial sector has made out like a bandit here, whereas some of the nonprofit tech sides, they just took them out behind a barn and shot them.
There you go. A nice fishing point to say, go to victoradair.ca, victoradair.ca. Have a look at the trading charts. I mean, they're right there. Great stuff there as usual. Vic, thanks for taking the time.
Mike, always a pleasure talking with you.
Time now for this week's Goofy Award. And it's one that I find extremely troubling. Some would say it's the latest chapter in the vaccine wars. And I might add the fact that no one seems to need an explanation of what I mean by vaccine wars. And I think that speaks volume, because it wasn't very long. It wasn't a long trip from Prime Minister Trudeau or people like BC's health officer, Dr. Bonnie Henry, stating unequivocally May last year that there would be no mandatory vaccines. They shifted that to a promise during the federal election to implement a mandate fueled by, obviously, it was polling that found that vaccinations were a wedge issue. And it's been an emotional, divisive issue ever since, highlighted by unvaccinated healthcare professionals being laid off despite personnel shortages in the system. Hey, you know what? Saw a poll this week, a Maru poll released, that found that 60% of Canadians support fining people who were not vaccinated. In BC, that number, by the way, was 64%, led the country. Now, while it would be tough to get the impression from the media coverage, you know what? Vaccine mandates are still highly controversial, with some medical professionals as well as individual rights activists really wanting to discuss it, or against it, I should say. But it's obviously a political winner, which is why the Prime Minister has no problem amping up the divisive language, saying many of the unvaccinated are misogynistic or racist. Hey, by the way, I better say this up front. I've had 3 vaccine shots, but I do respect how complex this issue is. So did the Goofy. This week, a father of a 4-year-old boy with leukemia, along with his family, who've been staying at Ronald McDonald House while his son receives treatment, got word of he got a written new policy regarding vaccinations dictates that said they'd have to leave by the end of the month because they weren't vaccinated. They've been there since October. The policy states that everyone 5 years and older who are working, staying, or visiting Ronald McDonald House in Vancouver must now show proof of vaccination, 2 doses, in addition to completing their screening. Well, as the poll numbers suggest, many are going to say that serves them right. Everyone should be vaccinated. Others, and I have to say I'm in this crowd, are appalled. I mean, is this the best we've got in terms of compassion, generosity of spirit, and understanding? Well, of course, as a country, we've shown no interest in those qualities when it comes to personal choices, when it comes to vaccination. And I think that's no surprise given the leadership and the politics of division that's been so front and center. But fortunately, in light of the publicity and maybe even the public backlash, Ronald McDonald House, by the way, has responded and has done the compassionate thing and is arranging alternative accommodation for the family. But the restrictions, of course, will remain, in quotes, to prioritize the health, safety, and welfare of the vulnerable populations, end of quote. But you know what? I see this as a bigger issue, is our attitude toward people who've chosen to be unvaccinated. I think it merits more discussion. I think it always has. I think engaging in discussion is a better approach. As I said, vaccine mandates aren't controversial, and they've been hijacked in large part by politics, running up against the reality of laying off unvaccinated workers in essential industries like healthcare. We're now worried about truckers and supply chains. But I think the effectiveness is open to debate. And that's what we should be doing, especially with the spread of Omicron. And one thing that has been clear, though, and this is my point, has been clear from the outset of the pandemic. We have no interest in open, respectful discussion examining any departure from the official government position. And you know what? For me, that's the goofy part. And I know right away a lot of people will disagree. But I'm more, instead of vilifying, I think it's better to continually open up the discussion as best we can. Hey, that's all the time we have. And again, I want to remind you to join me on Money Talks tweets I think you're crazy not to. It's a ton of free information. You'll be better informed. Also, you can go to Michael Campbell's Money Talks Facebook page. You can go to Mike's moneytalks.ca. And as I say, hey, the countdown's on for the World Outlook Conference. We're within 3 weeks of starting that one. So the countdown's on. And boy, there's no shortage of things to be talking about and prepare you for. So go to mikesmoneytalks.ca, click on the events button. I hope you join us right there for the online version. In the meantime, I wish you well. Hope you have a terrific week.
This is the Money Talks podcast with Michael Campbell, available at mikesmoneytalks.ca or through your favorite podcast subscription service. Join us on Facebook at Michael Campbell's Money Talks and on Twitter at Money Talks Tweet.